Okay, I will go ahead and get started. Welcome, everyone. Welcome to my webinar on building portfolio resilience, adjusting your risk models for bias created by the COVID recession. Please note the instructions below. You are all muted, and please don't hesitate to send any questions throughout the presentation using the Q&A window at the bottom of your screen. I will address as many as I can at the end, time permitting. I'll introduce myself before we go into the presentation. I am Eric Steinhoff, EVP of Client Impact here at Synaptic. I have about 22 years of experience in credit risk analytics and lending strategies, and I have led risk functions at various lending organizations from large banks like Capital One and Standard Bank to smaller startups like Scale Factor and Apple Pie Capital. So let's go into setting the background of why we care about what's going on to our models and why we are confident that models are losing risk prediction power. So first off, the header, unemployment has peaked, but is expected to settle in the high single digits. I think the Fed came out last week and said that they expect unemployment of 9.3% at the end of the year in the US. That's, I think, probably about as good of a case as I would suggest. I can't see many scenarios in which unemployment ends below that number. And then we have some data on these charts from the TransUnion Industry Insights report, the quarterly report they publish. They offered information on percent of accounts in hardship, and these aren't skyrocketing. These are skyrocketing relatively. These aren't as high as unemployment might suggest, since we know unemployment's in the mid to high teens. But we see that from March to April, you see over a 5x increase in most instances, other than personal loans. And in April of last year, similar. So this is hit hard, and of course May will probably look worse. On the right, we have the opposite happening, which is that we don't yet see an increase in borrowers that are 60 or more days past due. So this only goes through April, but you can see that April 2020 looked just like March, which looked just like April 19. Obviously, we know that 60 plus is a lagging indicator. On top of that, I'm sure most of you are aware that a lot of lenders have been providing payment holidays, payment deferrals, and so it will take quite a while for these 60 plus DPDs to actually appear in the bureaus for informing your models. I have another piece of data from TransUnion. Actually, they did a pandemic impact report that they've updated several times. The latest one I found was as of May 25th. And these numbers, I've looked at like 3 different versions of them. These numbers continue to worsen as the pandemic continues. 58% of Americans said that their household income has been negatively impacted by COVID-19. That's up from, I think, 50% 2 weeks prior. 70% said they are concerned about paying their current bills and or loan payments. And then you get down into the impacted customers. Of that 58%, 54% said they will struggle to pay for housing, mortgage and rent. That's adding mortgage and rent percentages together. And another 60% of them have reached out to companies that they have payments with and to discuss payment options. So this is hitting over half of the over half who have been adversely impacted. And already 25% of those say that they are using accommodations offered by their lenders, such as forbearance. Okay, I'm now going to kick off a poll. I like to do these to keep my audience engaged. Oops. Let me bring this up and launch. So there are 5 questions here. Please, it should be popping up on your screen. Please answer As it does, the questions are around the information you have on your customers. So do you have employment data on your customers? Do you use early warning indicators in your portfolio management? What % of your portfolio do you estimate works in industries that were highly impacted by the COVID shutdowns? So restaurants, tourism, etc. And I will get into that on the next slide. How did you or your bank respond to the COVID and unemployment news in the mid-March to mid-April timeframe? So did you shut down originations? Did you tighten? And then finally, if you did tighten, what is the current status of your origination strategy? And I'll again remind everyone, because we've had several more people join, throughout this presentation, please feel free to post questions in the Q&A box. There's a little graphic here that shows what that looks like, and I will address as many as possible at the end of this presentation, time permitting, and then we will answer any material questions afterwards via email. I did see one question pop up about, will we receive the presentation slides after the meeting? I don't believe we will distribute them to everyone proactively, but if you reach out to our email account that I'll show at the end, you can request the slides. We also will probably send out a follow-up email to everyone who attends, and you can use that, reply to that to request the slides. Okay, I'm gonna let people continue to answer the poll questions. It looks like we have about half of you have voted. Once we get kind of 75% plus, I will we'll start to read the results. But moving on to the next slide, as I said, I have a slide here addressing the impact on certain industries more than others. These are two charts from third-party research centers that show effectively that the people most impacted by the COVID shutdowns are lower income people. So you can see here the average weekly earnings by industry is around $1,000 in January 2020, but those with workers at higher risk of job loss all fall below that average. And then on the right, this is a nice graphical illustration of which industries and therefore which workers have been hit badly on the two fronts of liquidity impact and then profitability impact. So retail, airlines, tourism, and travel, sales are way down, liquidity is crunched. That means layoffs have happened, furloughs have happened, and layoffs will honestly likely continue to happen. I personally do not think we've seen the brunt of business shutdowns yet. We're starting to see some large bankruptcies, Hertz, for example, JCPenney, but I think one of the large retail fancier retail mall outlets, I'm drawing a blank now, have all filed for bankruptcy. And so layoffs and furloughs have happened and will follow, but I do think restaurants have not yet started to shut down in the magnitude that we will see. Okay, and I'll continue to let the poll go. We're still hovering at around 50%, but after a couple slides, I'll start to read some of those results. One other thing we know that I alluded to earlier on the slide, a few slides earlier, is that defaults will occur when people lose their jobs. However, defaults and roll rates traditionally lag unemployment, and the treatment, things like the CARES Act allowing forbearance on mortgages, government stimulation, the checks being mailed to everyone earning less than whatever the figure was, $200,000, the $1,200 checks that may come again on top of extended unemployment and unemployment benefits being extended even for people who couldn't prove that they were looking for a job. All of those things will have a delaying impact on the first late payment. But this doesn't even assume any of those government interventions. This chart, which I think is a pretty baseline chart, doesn't even account for that, and shows how the credit default on a bureau can happen 180 days after financial difficulty starts. So you think about the timeline, the crisis hits, person experiences a loss of income. Sorry, that shouldn't be plus 30 DPD, it should be just 30 days. 30 days later, they request a payment deferral. Maybe that's granted for 3 months. That was kind of the standard offering. So 3 months later, that payment deferral or forbearance expires. So now they're back on the hook for making payments. They stop making payments. 2 more months pass. So 60 days later, they hit 30 plus at the bureau, and then another 2 months later before they hit 90 plus and are listed as a default or charge off, or potentially 120 days for a credit card. So it could be 210. So this only assumes forbearance programs in place, does not assume that customers can extend the payment deferrals by making payments due to government checks being mailed to them, which we have all seen. And finally, just kind of wrapping up this section and talking about the bias that is inherent in models caused by this recession. We've seen this before. This is not new. In 2008, we know that models broke down, and I have a pretty direct example here for FICO, looking at mortgage defaults and subprime loans. So we can see on the left here, in 2003, the score difference between mortgages that defaulted in the first 12 months after origination versus those that did not was pretty substantial. There was a 31-point difference between those that defaulted and those that didn't. On the right, we can see by 2006, that had gone away. So the risk that was created by the early stages of the recession, remember, mortgage default started to uptick in 2007, but really the rest of the economy wasn't hit as bad until 2008. But even by loans originated in 2006, 12 months later in 2007, there was very little score difference between goods and bads. On the right, we also see this is for subprime loans, and so you're going to see a higher serious delinquency rate of customers in the 600 to 620 FICO versus those 700 plus. But what you can see is while the order of magnitude of risk increase is similar, so 600 to 620 between 2005 and 2007 saw approximately a 10 percentage point absolute increase in delinquency rate. You saw almost the same in order of magnitude, so 8 to 9% increase for those 700 plus. But in terms of the multiplier effect, you're talking doubling of the risk odds for the 600 to 620 versus 4x-ish for the 700 plus customers. So this is indicative of even when FICO sees continued risk splitting, right? The 2007 600 to 620 have a much higher delinquency rate than the 700 plus, 18% versus 11%. I strongly doubt that anyone's models predicted that that increase was going to happen. And even if you did anticipate an increase, it's unlikely that you used a higher multiplier on the 700 plus than on the 600 to 620. Okay, I will go back and read a couple of the results from the survey. We've got about 55% voting, so would love people to continue to respond. Talking about employment data, questions 1 and 3. So do you have employment data on all of your customers? So yes on all is only about 7% of respondents. Yes on most, 30%. Yes on some, 38%. And no on none is 25%. So definitely skewed towards fewer than half, 37% saying most or all, and the remainder saying some or none. Next question, related to income, I'll skip to number 3, related to employment. What % of your portfolio do you estimate works in industries that were highly impacted by COVID shutdowns? So restaurants, tourism, et cetera. 15% of you said you think that a higher percentage of your portfolio than the US overall. 34% said similar to the US, 39% said lower than the US, and another 11% said no idea, don't know. So I think summing that up, 26% of you say it's higher or don't know. The majority of you saying similar or lower, that's about 73%. Back to question 2. I'm going to talk in a little bit about some tools you can use, early warning indicators being one of them. And so the question was, do you use any early warning indicators in your portfolio management? 21% of you said yes for loss forecasting. 11% said yes for strategy, such as line management. 38% of you said yes for both, and 30% said no. And so my hypothesis was going to be that most people were using for loss forecasting or not at all, not as much for strategy, but it looks like it's about 50-50. 50% using for loss strategy or not at all, 51%, 49% for strategy or for both. And then getting into the questions about risk tightening or loosening with regards to how your bank or lender responded from the mid-March to mid-April timeframe. 8% of you shut off originations completely, 30% tightened originations significantly, 41% tightened slightly, and 21% did not change or loosened originations. So about 38% of you shut off or tightened significantly, another 62 slight tightening or loosening. And then finally, if you did tighten in the March or April timeframe, what is the current status of your origination strategy? None of you are currently shut off. So that's consistent with what we've seen with lenders we've worked with. Quite a few shut off for a short period of time just to reassess where things stood, and then have since reopened slowly. The remaining people, 21% remain significantly tightened versus pre-March. 53% remain slightly tightened versus pre-March, and 26% of you have gone back to where you were pre-March or looser, which is consistent with no change loosened. So what I read from that is that those of you who tightened have eased up somewhat. Those of you who did not, but it doesn't look like those who tightened have gone to where you were pre-March 2020. And with good reason. I think there is still a lot of uncertainty out there. And what I'm going to cover for the rest of the presentation is some tools and recommendations we have to address a lot of that uncertainty. So specifically, what can you do about this? And when I say this, I mean the bias that we know will be happening in your model and that we've seen before in FICO. So what can you do? I think there's 3 different things that all of you should be considering and seeing if they make sense as ways to enhance your risk prediction tools, given the biases created by the macro conditions. So the first one is, are you confident that you understand the COVID risk for your borrower base? So coming back to that question of, do you know, for example, what industry they are employed in? Do you if you don't, can you get that data either directly from the borrower or can you purchase it from third-party sources? There are a multitude of data sources out there that I think now is the time to be evaluating, especially if you want to get back to a strong origination strategy that you can feel confident in. Second is to evaluate and implement early warning indicators. So I'll talk a little bit about this. But this is something that, like I said, my suspicion was that most of you were using them either not at all or for loss forecasting. It turns out that roughly half of you, it sounds like, are using them for credit decisioning, like line management. But I think the other half of you absolutely should evaluate that. And then third is obviously adjusting your risk models to reduce bias. And so I'm going to talk about 3 different paths that you can take to address that. So 1, overcoming data limitations. So just to set some background, data and technological challenges impair your ability to make the best, most timely decisions. So what do I mean by this? Well, we've already talked about the fact that traditional bureau data is now more lagged and therefore not predictive, right? If you're learning 150 to 200 days after they have experienced financial stress or financial difficulties, that's not predictive, that is lagging. On top of that, we do see, as I said, an abundance of data available out there. However, it's a bit of a challenge to evaluate which ones make the most sense for your situation, which ones are relevant for your borrower base, and then most importantly, how it's structured and can you easily incorporate that into your decision making. So data is often unstructured. Good news is that there are a lot of new technologies that are available to marry unstructured and structured data to give predictive signals. So I'm talking about things like NLP, natural language linguistic programming or processing that can identify text from scanned images and input those and use them to create indicators or variables. OCR technology does scan PDF type documents and extracts relevant data fields. A lot of these are used for things like bill.com, processing bill payments, standardized documents. You can extract a lot of information from, say, tax returns, especially if you're doing small business lending where you may have tax returns. The point being that there is a lot of data out there, and now is a great time to reevaluate which data you're using and how are you maximizing the full ability to get extract variables, attributes, indicators out of that data. Another point I want to make here is that we shouldn't assume that there is a single solution, a one-size-fits-all solution for all problems or questions you might be trying to answer. So the example I use here is, how can you estimate the likelihood that your borrowers will lose their job in a stress scenario? One way is simply common sense. We know, as I highlighted before, that certain industries have been adversely impacted more than others. This recession is not hitting everyone equally. And you can use that information, and I'll talk about in the final section of this presentation, I'll talk about a way that you can use a simple multiplier in your models for the purposes of leveraging that data. Or you can go a more complex route. You can build a model to predict who will default given a particular kind of stress. So you can build a model to identify which of your borrowers may be more susceptible in a COVID type recession where it does hit specific industries, and that would be different than a model built to predict which of your borrowers will experience stress in a more traditional macro recession. Now, I'm not saying that all recessions that traditional recessions impact everyone in the economy the same. That's not the case, but a more traditional macro recession through an economic cycle would have a broader impact and less concentrated than this COVID impact. So the point here is, do not assume that models or data sources must be 100% accurate, or that you can't adjust your models and rather just have to adjust up your probability of default predictions across the board. You can absolutely segment and tailor your risk prediction for the scenario going on. Again, talking about data sources, but also just what data do you need to make the best decisions for your portfolio. And so there are things like adding financial questions to your customer engagement procedures. So when they call in for any reason to talk to a human representative, whether that's to request payment relief, payment deferments, or otherwise, you can ask some financial questions. Have you lost your job? Have you seen a decline in income? And start to capture that data for the purposes of making better credit decisions. Also, if you have access to bank account information, either because you are their primary checking provider or you have bank integrations, you can review that. You can see not just are their payments, their paychecks being deposited, but you can also see just balance trends, and that can be hugely informative for the financial situation your customers are experiencing. You can also verify employment status. This is, something I would highly recommend for originations with people you don't have the above information on. You aren't asking these questions. Go ahead and verify, ask for their employer. You can supplement with third-party data sources I've talked about. You can actually estimate equity in the home. You can see how long they've lived in their address, how long they've had their mortgage, and you can make an approximation for, we all know the traditional mortgage is going to be a 30-year loan, and it will see principal balance slowly paid down at the beginning and more aggressively towards the end. And that can be used to estimate how much equity they have in the home, along with home price increases, maybe in that region. And that can provide a pretty good proxy for whether this person has a positive net worth and therefore the ability to continue to sustain themselves even in the face of loss of income. Other things like that would be spousal household financial indication situation. So do they have another worker in the house, another earner? And finally, the presence of savings or a 401k. How would you know that, you might ask? Well, a 401k you can probably approximate by the income level, industry type, and time in the job. If they've been in their job for a long time and are earning a level that would be commensurate with someone who probably takes advantage of a 401k, you can make some assumptions there. That being said, those are assumptions, and therefore you need to make sure that you are aware of the risks and trade-offs associated with making those assumptions or implementing some of these data pieces into your decision-making process. So one thing I like to suggest is that short-term adjustments can work, but make sure that you set clear time and performance bounds. So for example, you might say that we're going to adjust the loss odds for people in tourism and hospitality related industries. That's fine, but what you don't want to do is just do that and set it and forget it. You absolutely need to set check back in, set dates for checking back in, reporting on how many people were impacted, set possibly a dollar exposure limit. So you say we will run this for 60 days or however many hundreds of millions of dollars of lending or tens of millions of dollars of lending before we come back in and reevaluate and make sure that we think that risk multiplier continues to be relevant. And also remember that approaches are not mutually exclusive. So we talked earlier that question about do you have employment information on your customers? And the majority of you said yes on most or yes on some. Only about 33% of you said yes on all or no on none. And so that can feel like it's going to hamstring you to not have that information on everyone, but you can absolutely use the information where it's available and then assume an average risk level increase for those that you don't have that information available. On top of that, you can use that as a quick and dirty adjustment to your loss odds for purposes of making credit decisions while building longer term solutions, such as building new models to predict the probability of default or probability of job loss. And I'll talk a little bit more about that in the next two sections. Second item I discussed was leveraging early warning indicators. This is something that, again, about half of you have in place, not just for loss forecasting, but also for making credit decisions, things like limit assignment, limit adjustments. But triggers are increasingly important. Someone who worked at a restaurant that may be open today and closes tomorrow, it would be very helpful, I assume you would agree, to know that they've lost that job or that that business is, that employer is going out of business for the purposes of making sure you don't maybe extend additional credit to that customer. And where can you get this data? There's actually a lot of sources. There are great options to buy. The bureaus are all trying to sell more timely data indicators because of the lags I talked about several slides earlier. They are trying to provide information showing you when a customer misses a payment or rolls from, say, 29 days to 30 days past due or 59 days to 60 days past due. Those can be hugely informative versus doing a monthly batch or quarterly batch run. There's also alternate data sources. AVOX data is just one of many that can provide information on things like the employment status of your customer base. And then over on the right, don't hesitate or don't discount the ability for you to organically generate triggers for the purposes of making better credit decisions. I mean, one thing I always come back to is ask the customer. If you have them engaged either on a phone call, if they, you can send out surveys to your customer base. There are lots of ways when they log into to maybe check their credit card balance. You can have questions pop up. Are you still employed? What is your income, et cetera. Those are pieces of information that should not be discounted directly from the source. You can also derive it from behavior, as I talked about. If you have access to their checking account balances over time, you can see that. Credit card balances over time can absolutely indicate that someone has possibly lost income. If they previously, 12 months ago were utilizing below 50% of their limit, and now in the last 3 months they've gone to 90% limit utilization, that's a pretty good indication that something has changed there. And you can also derive from internal data. And so this is back to information you have maybe on their employment at the time of application. What was their income? What was their industry? What was their job title? And those can be used to create attributes and or refine your risk predictions without having to go back to the customer and ask for that information. Now, triggers are going to be more useful for certain products than others. For example, mortgage and auto loans, there's not a lot you can do. Even if you see that someone has lost their job, if they are in a home or driving a car that you have financed, there's not much you can do to change that lending relationship once you have funded the purchase. That said, down below are several of the ways you can use it. You can use trigger information, and the one I come back to, and as I said, my hypothesis was that most of you would be using, is loss forecasting and capital adequacy measures. Those can absolutely leverage triggers for the purposes of making sure you are not caught unaware, and often, your credit strategies will be dependent on what your loss forecast is, and if your loss forecast starts to materially uptick, that can change how you originate, even if those triggers wouldn't have necessarily informed your origination decision directly. On top of that, they can help improve collections efficiency. We all know knowing more about the financial situation of your borrower in collections can help you prioritize and then determine the best channel or strategy to use with them. Over on the right here, I talk about card or loans where you maybe have a variable limit ability. So loans meaning more like a line of credit than a term pay down loan. But you can have a material impact by using triggers to inform your risk assessment and make better credit decisions. So that includes both of these two bottom boxes on the right. Adjust risk models to enable more timely and accurate risk assessment directly for these two types of loans on the right, and also reopen and expand originations with confidence. So this is not just about making great decisions, but it's also having confidence that you have obtained and leveraged the most important data available for your decisioning to eliminate as much of the variability or uncertainty as possible. Lending always has uncertainty associated with it. Our job as credit risk leaders is to manage that risk, that uncertainty risk, and also to make an assessment and feel confident that we are doing the best we have with the information available. Now I'm going to jump into the final section, which is what's tied to the title of this presentation, which is how can you adjust your models for this new bias that we know is occurring in risk models across the board. So once you've addressed the data and timeliness challenges, we recommend that you try and determine the best approach to adjust your models for bias. And there are three approaches that I'm going to walk you through. One I alluded to earlier, which is to modify the odds by segment. This is a simple multiplier effect. Does not require expansive data science capacity, does not require a huge budget, but also is going to be the bluntest tool out there and probably doesn't make the most sense if you have a lot of dollars at risk, or if you were one of those people who stated that you think a high percentage of your portfolio was impacted by the COVID recession, or if you don't know. The second option, and I talked about this in my previous webinar, if you attended that, I will have one slide from that I carried over here, which is to overlay a borrower stability index. So this is the idea of using whatever data you have, both from the Bureau and information you have about the customer's usage patterns on your loan product, to assess their incremental risk given this COVID shock. And so the typical example I give here is the same one I made several slides earlier. You see someone whose utilization has increased over the last 12 months, and or you see them hitting 90% plus utilization in the last 3, 6, 12 months. Even if you had that information before the recession hit, just knowing that that customer is teetering close to the edge, is maybe affording their lifestyle through credit, that person is going to be more vulnerable when a recession hits. Even if they don't happen to lose their job, the group of people at 90+% utilization will be higher risk than the group of people at 50% or below, and more higher risk, I would argue, in a COVID-induced recession than in a normal benign economic environment. This option is great for, box below is, it's much more precise than the modifying odds by segment, but it does not require a lot of additional customer specific data. I think, as I said, you can use Bureau data, and we've built a proof of concept built exclusively on Bureau data, not leveraging any internal data from a lender. We also, if you want to contact Synaptic, we actually have an off-the-shelf framework for that proof of concept, which can even accelerate the time to get something like this in market and overlaid into your portfolio. It's also fast to implement. So the one on the right is going to be the develop custom models is going to be more accurate, but we know how long model build cycles can take. There is not just the build process, but there's the implementation and the approval process internal to lenders that can really create significant delays. And a borrower stability index overlay can be a way to shortcut that. And honestly, as I said before, none of these are mutually exclusive. You can absolutely apply the modify odds by segment today and build a borrower risk stability index in the next 30 to 60 days to implement, and then in parallel, start a process to develop custom models, which I'll talk about in a bit. But the custom models are obviously the most accurate, but the most timely and most complex approach for this. And this I would strongly recommend if you have a large dollar at risk. So dollar at risk means if you either have a lot of your portfolio that is you expect to be impacted by COVID, or you want to continue originating at a high rate, this is going to be the best way to do it with confidence. But it does require time, capacity, bandwidth, either data science expertise in-house or budget to hire a third party. And it also requires budget or ability to get better data than just your standard Bureau quarterly attribute refresh. However, this is a longer term solution, and I would argue that this is something that most lenders should undertake regardless of the COVID recession, and I'll talk about that in a little bit. So I just have one slide on the simple overlay because it is simple and doesn't require a lot of explaining. Idea here is to estimate the increase in default probability based on the industry your specific borrower may work in. So in this, we have 3 examples. If they work for the federal government, they're probably not going to lose their job due to COVID, and therefore no risk odds multiplier would be required. However, if they work in tourism, there's a very high chance that they're going to lose their job, and maybe you double the loss. Maybe you want to go even higher than that. In the middle, maybe oil and gas is, we've seen gas prices plummet. There definitely have been financial shocks there, but not to the extreme of tourism. And then you also would need to remember that you probably don't have this detail on every single one of your borrowers, so you have to also estimate a overall probability of default increase and apply that to those borrowers where you don't have that information. So if you think the overall risk is going to increase by 50%, you want to make sure that the distribution of your portfolio times these multipliers increases your overall predicted PD by 50%. And this is just illustrative. It does not have to be on, as the note below says, does not have to be based on employment data, but that would be a pretty easy way to circumvent a lot of sophisticated model build, or even something like a borrower stability index. And like I said, these can be implemented in parallel or in sequence. Putting something like this in place to get back out there originating while you pursue some of the other options is absolutely something that most of you should consider. Medium, so this is option 2. This is the stability index that I've talked about, and I do have one slide that I carried over from a previous webinar, but this is to overlay a stability indicator onto your existing risk models. And the stability index or indicator can be built using available bureau and internal data. As I said, our proof of concept model or index was built exclusively looking at bureau data, and we actually only, I think, in the end used about 7 variables for the risk prediction that I'll show you in the next slide. But that would indicate that you can get a lot more power than we even presented in our proof of concept by using the internal information you have available that goes above and beyond what a bureau can tell you about your own customers. Good news here is it does not require detailed customer demographic data like job, industry, savings levels, 401k, equity in the home, although I would argue you can probably approximate equity in the home as an indicator if you can look at their time and address or the age of their mortgage. But again, this is something that can be built with or without great data. And finally, the index can be implemented simpler. As I talked about, building models, getting them approved, getting them implemented can take quite a bit of time. An index where you overlay and just apply a multiplier or a higher risk probability to certain subsets of your portfolio can be a quick and dirty way to get the benefit. You also can ultimately build it into your existing PD models if you want to go the more thorough and rigorous diligent route. And I would argue, again, some of these variables would be like the utilization one. Your model probably knows that customers at 90% utilization are higher risk than customers at below 50% utilization on their credit cards. That's not news. However, what your model doesn't know is that when a recession hits, or that doesn't know that we're in a recession, and therefore when that recession hits, that the loss odds between the person who's at 90% plus utilization and 50% utilization increases. So your model accounts for how that works in a benign environment in all likelihood. It does not adjust for a macro downturn, and a borrower index is a way to address that. And then you can build that into your models permanently for the purposes of overlaying a probability of a recession occurring into your risk prediction, which could then know whether to dial up or down that loss odds. Here's the slide I referenced that I showed in the webinar about a month ago. We did prove the ability to identify customers who have either high stability or resilience or low stability or resilience, even within a given score band. And we proved this again using only 7 variables just available from credit bureaus. We did not use any internal data that a lender might have had. As you can see here, just grouping together the low resilience and very low resilience, or low stability and very low stability buckets. They are significantly higher risk than those identified as high or very high resilience. In most cases, more than 10x. I think the highest case was a 20 to 25x risk increase within a given score band. And then finally, the third option that I think is something that I would recommend all of you evaluate or consider. And again, if you have the time, budget, and really want to start originating confidently, this is something that is a great option to pursue in parallel to some of the short-term risk adjustments to enable you to continue to originate or reopen confidently. And what this looks like is to build custom models, probably two different models. One would be the probability of job loss, and then the second one would be the probability of default given job loss, because as I have referenced several times before, if a customer has high savings, if they have a lot of equity in their home, if there is another earner in the house, they may not default or may not default as quickly or may not have the same severity of default as someone who does not have savings, does not own their home, and is the only breadwinner in the house. The strength of these models will be a function of the level of data you have or can obtain on your customers. Again, this budget associated with developing something like this is not tied to just the data science resources, but also the data you can acquire. But again, I'll come back to what I talked about in the first section about data availability. There is a lot of data out there, and it absolutely can be used to build more predictive models that are more relevant today than whatever you have in place, but also will be more relevant through the cycle. If this is done correctly, this is not I am not talking about these as being a COVID-only model. You can absolutely imagine that in 5 years or 3 years, hopefully, when things have returned completely to normal and we're at a sub 5% unemployment rate, there is still going to be a probability of job loss for every borrower in your portfolio. That job loss probability will just be much lower than it is today. And there will also be a probability of default given job loss. And again, that may be lower than it is today, but if they are highly leveraged, that may be the same. And so these are models that are not unique to this time, but rather risk overlays that can be usable, useful, and really give confidence through the cycle. And so here is, again, two distinct measurements. You're just really to predict the probability of a COVID default for today, or a job loss induced default is just the probability of A times the probability of B. A is the susceptibility to job loss or other cash flow shock. Maybe it's a job loss of a spouse or some other breadwinner in the home. What can predict a job loss under a macroeconomic shock or otherwise? Level of income. We know with this recession, lower income people are more vulnerable, not just more vulnerable because they probably have less capacity to withstand a shock, but also more vulnerable because those are the jobs that people have lost. Time on the job, people newer to the employer are probably the first ones to be fired when layoffs happen. And level of education, we know that most of those lower income jobs are tied to lower levels of education attainment, high school versus college, for example. Those can all be very useful indicators of whether someone is susceptible to a job loss now or in any specific macro scenario. And then the second model, ability to survive without defaulting. I've talked about a bunch of these on the left. Looking at bank statement data, that will be quite predictive. Do they have a 401k, IRA? Again, you can model for the probability of that. You don't have to know it explicitly. Equity, time, and home, again, can be a proxy. Time in the home can be a proxy for equity in the home. There are other second order indirect variables that could include recent delinquency history. Again, trends can also help inform that. Have they been delinquent recently where they weren't maybe delinquent 2-3 years ago? The revolving debt ratio, so have they ramped up utilization overall? Credit card payment history, utilization, recent trends can be very informative. Marital status and dependence are obviously a little dicier for modeling purposes, but they absolutely can be informative in a, say, loss forecasting model, and can help understand how resilient this borrower is to a job loss. So if they're married, there's a good chance there's a second earner in the household. If they have multiple dependents, then there's a good chance that they have a higher cost of living. And so to wrap it all up, what I want to talk about is how do you get started? This is a lot of information I've thrown at you. What is going to be the relevant approach for you given your situation? We talked about the available data out there. We talked about leveraging early warning signals or triggers, and we talked about rebuilding your models or overlaying onto your models. So where should you start, and how do you think about which approach might be right for your situation or your portfolio? So first, data. Really the best advice I can give is figure out which questions you need to answer and then determine how you might answer them. So if the question you need to answer is, do my customers have a high probability of losing their job? How you might answer those is, you can take two different paths. One is ask them, have they lost their job? The other is try to figure out which industry they work in and determine a probability of job loss given that industry. Early warning signals, these again are going to be more effective for cards and line of credit type loans where you have the ability to restrict or at least not increase limits. And the way to think about this is the trade-off of accuracy versus timeliness. How important is timeliness to your strategy? So triggers can be extremely useful, again, for those products from a credit risk management standpoint and loss management standpoint. I would argue on a mortgage or auto loan portfolio, accuracy is more important than timeliness. However, at the time of application, timeliness obviously becomes much more important, especially for a car loan where the ability to get someone approved and in that car on the lot can be a make or break. On a mortgage, you definitely have more time, and therefore I would say accuracy is more important than timeliness. And then finally, models. So I think I've pretty definitively established that your models are now biased. The fact that this COVID recession is not impacting everyone equally means that your model is not predicting correct on some subset of your portfolio. And even if you overlaid risk indicators, cut off on the margin, that is a blunt tool. That is not, if you cut off your maybe min FICO from 620 to 680, that does not accomplish the bias adjustment. And so for this, you really need to go through, I provided some tips here on evaluating the dollars at risk, what your budget is, what your capacity is, and how urgent this issue is. And that can help inform whether you undertake a simple multiplier approach or a more complex model rebuild approach. And that, again, I will remind you that those are not mutually exclusive options. You can absolutely implement one quickly and in parallel start the model rebuild process for a much better long-term solution that, built correctly, will be usable through the economic cycle, not just when an economic downturn happens. Okay, thank you very much. I am going to turn to questions. We have about 5 minutes. And so I will jump into those. I did already at the beginning address the one question around whether we will receive presentation slides after the meeting. I don't see an email here, but we will send emails out to everyone with that you can respond to and request a copy of that, and or someone will reach out to you to provide it. First question, shouldn't we have had these indicators before the crisis hit? How will they help me in the next crisis versus just reacting to one that has already hit? That's a great point. And as I was just saying at the end, building a true job loss prediction model, or probably a default given job loss, built correctly and leveraging macroeconomic indicators into that model can set you up for success through the cycle and therefore help you in advance of a downturn. Now, the COVID downturn was a bit unique. If you look at all economic indicators, they were all pretty positive. Even though most people were predicting recession in the near future, that was more of a 18 to 24 months out prediction by most economists as of, say, January of 2020. And we know the recession hit in Q1. And so the COVID one was a bit unique, but if those models were built correctly, you can at least quickly respond, if not predict the downturn. a normal through the cycle recession would give you more lead time and enable you to anticipate that. Next question, how much longer do you think the stimulus checks will last? Many hourly employees are choosing to stay unemployed because unemployment and stimulus pays more than their regular job. Yeah, as I referenced, I think a lot of states were not requiring proof of job seeking. That is no longer the case, at least here in Texas, where I live. I think a lot of states, now that the economy has somewhat reopened, are starting to require employees to, unemployed people to prove that they are seeking employment to continue to receive unemployment benefits, which is how unemployment normally works. And so I think that will address that concern. That said, another round of stimulus checks can certainly help, can certainly delay defaults. We all know that. In fact, that was one question that didn't make the list that we wanted to ask in the poll because we wanted to keep it to 5. But I wanted to ask, what loss performance have you seen in your portfolio since March? And the reality is that most people I've spoken with have not yet seen that uptick in defaults or even material uptick in delinquencies. We know anecdotally and from looking at the data that a lot of people use those $1,200 checks to pay down debt. And that was because their income hadn't yet been disrupted. And what else are you going to do with the $1,200? And so that may happen again. I think we learned, hopefully the government learned some lessons about the broad, let's mail everybody a check, to maybe mailing more targeted, or I've seen proposals thrown out there about making sure that people use it to spend, not to pay down debt, which would absolutely help the economy more. Paying down the debt isn't really, doesn't have any multiplier effect on the economy. But I'm not an economist. I don't have a strong hypothesis around how much longer the stimulus checks will last. Another question, how do you price this? So I assume this means, how do you price the credit risk increase that we're anticipating or we know is going to hit a subset of the portfolio? And the answer is, presumably you're engaging in some form of risk-based pricing, and therefore an increase in your default prediction should directly flow through to an increase in your pricing. That would be the most straightforward answer I can give you. Next one, how do you think about data sources with regards to quality? For example, comparing indicators coming out of open source government data versus third-party sources like bureaus. My answer here is I really think about a level of control over the data and what the data was intended to be used for. So when I say control over data, if this is data you're collecting on your customers, that is better than data you are getting from a third party. In almost all instances, bureaus are pretty reliable. But other than that, I would always trust information I can get from my customer, either by asking them or by observing their behavior on a loan they have with me. So I would always prioritize data I control over data that I do not. And then the second piece, as I said, is what was the purpose of the data? So bureau data is absolutely built for the purpose of lending money. So informing lenders so that they can make smart lending decisions. So that data is going to be better than, or I'm going to trust it more for the purposes of lending than, say, something like open source government data, which can be perfectly accurate, but was not designed necessarily for the intent of enabling lending. So just always question, when you're dealing with a new data source, question what the source is and what the point of that source is, because there can be some inherent biases in the data points collected that were, not consequential for the reason the data was collected, but would be consequential when used in a risk model. And we are kind of over time, so I'm going to ask one more question. I see quite a few coming through. Thank you all for the questions. These are great. In the current scenario, given moratorium relief, et cetera, even the bureau data can't be a true reflection of the customer's real stress. True? And yes, that is true. And if yes, leveraging bureau or internal data produced in recent months can create a bias in any segmentation. I do. So then how do you suggest using the bureau? Great question. Hopefully I addressed some of this, but the answer I would say is look at indicators that can be predictive versus those that are lagging. So payment defaults, lagging. Ramped up utilization can be predictive. And that is something that might be a month lag, but it's not going to be as severely lagged as a payment default, especially with moratorium relief. Similarly, as I said, there are lots of third-party data sources out there, and bureaus are happy to sell you more timely data. In fact, I know they're making big pushes right now to sell some of those early warning triggers for the purposes of identifying when someone tips from pre-delinquent to delinquent, so that you know immediately rather than waiting to receive that information on a quarterly credit bureau poll. Sorry, I never ended the poll. We got strong participation. I will share these results, but then we will also publish these results. And as I said, we'll send mailers out to everyone who attended. Please reply to those emails if you want to request the slides. I see someone here also requested the information on the impacted industries due to COVID. So if you want to request that information as well. Thank you all. Have a great rest of your day and week.